It's that time of the year when you have to lodge your tax return now. However, you're unsure how you can reduce your taxes and not overpay too much legally, of course. You know how the rich always pays $0 in taxes, but it always seems a bit out of your reach. Well, I'm here to tell you that it's not, and I'll share with you 5 very simple ways that you can reduce your tax bills to 0 using superannuation and build your wealth. Starting with the first one, salary sacrifice. Salary sacrifice is when you ask your employer to pay part of your pre-tax salary directly into your super fund instead of into your bank account. Now, why would one do this? Because that money is only taxed at 15% inside your super, which is usually a lot lower than your personal income tax rate of around 30% on average. Let's say you earn $100,000 a year and you decide to salary sacrifice $10,000. Now, normally you would pay around $3,000 in taxes on that $10,000, but in super, it's taxed at only $1,500. That's $1,500 in tax savings, and the full $8,500 stays invested and it stays growing inside your super. However, there is a limit to how much you can actually contribute every financial year. The annual cap for these is $30,000, and that includes your employer's regular 11.5% super payments. But if you don't use up the $30,000 concessional contribution caps in the financial year, the unused portion can be carried forward for up to 5 years, provided your total super balance is under $500,000 as of 30th June of the previous year. For example, in FY21, you contributed $20,000. That means your unused portion is $10,000. In FY22, you contributed $25,000. That means your unused portion is $5,000. In FY23, you contributed $15,000. That means your unused amount is $15,000. In FY24, you contributed $10,000. That means the unused amount is $20,000. Therefore, the total unused amount in FY25 is $50,000. However, in FY 2025, you still have your cap of $30,000. So you can contribute $80,000 in total. So that's the current $30,000 cap plus the $50,000 carried forward. So if you're on a 47% marginal tax rate, contributing this $80,000 could save up to $21,600 in tax, since you're taxed only 15% in super instead of 47%. And the best thing, you can change or stop salary sacrificing anytime. Just speak to your employer's payroll team. So you can see salary sacrifice is a powerful way to lower your tax bill and build long-term wealth for retirement. It's especially useful if you're earning a decent income and you want to optimize your end-of-year tax return. However, not every employer offers this, and you might not have enough time until the end of financial year to sacrifice the full amount you want. That's where the second strategy comes in. But before that, if you guys are enjoying this video and would like more insights and information on personal finance, real estate, property, stocks, crypto, make sure you check out my newsletter in the description down below. Alright, back to our second strategy, personal deductible super contribution. What is this? This is the method that will allow you to make concessional contribution and still receive the same tax benefits by reducing your taxable income like salary sacrifice. How does it work? If you're under 75 and you have room under your concessional cap being $30,000, you can make extra contribution to your super from your bank account and claim a tax deduction when you do your tax return. Here's one example. Let's say you earn $100,000 a year and you already got $11,500 from your employer into your super. That's the 11.5% from your employer's super contribution. That means you still have $18,500 remaining in your cap. You now transfer the $18,500 from your bank account into your super fund before 30th June. Then you fill out the notice of intent to claim a tax deduction form, and the ATO will deduct that $18,500 from your taxable income and at a marginal tax rate of 30%. That saves you $5,600 in taxes. And instead of giving it to the ATO, you just gave it to your future self in your super. Strategy number 3, spouse super contribution. This strategy is for those that want to save on taxes and help their partner grow their retirement savings at the same time. With this, you might be able to claim a tax offset of up to $540 by making a spouse super contribution. Here's how it works. If your spouse earns less than $37,000, you can contribute up to $3,000 to their super, and the ATO will give you 18% back as tax offset. That's up to $540 straight off your tax bill. Now let's say your partner earns $32,000. You transfer $3,000 into their super account before June 30 and you lodge your tax return. You get $540 back as a tax offset, not just a deduction, but an actual credit off what you owe the ATO. If your spouse earns anywhere between $37,000 and $40,000, you can still get a partial offset. It just phases out gradually. Important notes: your spouse must firstly be under 75, they must not exceed their non-concessional cap, and your contribution must come from your after-tax income. Strategy number 4, government co-contribution. Now, what if the government gave you up to $500 just for putting money into your super? Sounds too good? That's the government co-contribution scheme, and that's one of the easiest tax-free boosts you can get. Here's how it works. If you earn under $45,000 and you make a personal after-tax contribution of up to $1,000 to your super, the government will match 50% of that and contribute a max of $500 for free. That's a 50% return instantly. However, if you earn more than $45,400, this benefit tapers off gradually until it disappears at $60,400. Strategy number 5. Transition to retirement strategy. Now, what if I told you that you can start withdrawing from your super before you even retire? Legally, of course, and you still grow your wealth. That's the transition to retirement strategy, and it's a smart tax saving tool most Aussies overlook. Once you hit your preservation age between 55 and 60, depending on your birth year, you can start a TTR income or transition to retirement income stream while you're still working. This lets you keep working full-time and use the tax saving to boost your super faster. This strategy works the best if you're 60 or older and a mid to upper income earner. The middle income, according to the internet, was around $83,000 a year in 2024. Now let me give you an example. Imagine Jane, a 60-year-old woman still working full-time and has $250,000 in her supers. She's not ready to retire yet, but she wants to start accessing part of her super to reduce her tax and boost her retirement savings. Here's how it works. Jane transfers $250,000 from her super into a TTR account-based pension. With this, she can draw between 4% and 10% of that balance each financial year, even though she's working. So she decides to withdraw $25,000, which is 10% of her balance. Now, at the same time, she salary sacrifices $25,000 from her pre-tax income into her super. Because this contribution is taxed at just 15% instead of a 30% marginal tax rate, Jane now saves $3,750 in tax straight away. And here's a breakdown. Without TTR, that $25,000 in salary would be taxed at 30%, which equals $7,500. With the TTR strategy, the $25,000 salary sacrifice is now taxed at 15%, which equals to $3,750. Therefore, the difference between the two would be a tax saving of $3,750. Meanwhile, she replaces that $25,000 of her salary sacrificed income with a tax-free pension payment of $25,000 from her TTR account since she's over 60. So she keeps her take-home pay exactly the same. In short, Jane keeps the same income and pays less tax. And given TTR pension payments are tax-free for people aged 60 or older, this strategy is perfect for them. Well, there you have it. The thing is, everything I've mentioned to you is completely useless because there are still 10 other tips that if you don't follow, you will still be overpaying for your taxes. So watch this video next to solve them, and remember to subscribe to see further insights about personal finance, real estate, and stocks.